Yeah,
It's
great to see you.
Been too long.
It's been a minute.
It's been a minute, exactly. So the US dollar, I guess, has done quite a lot during those few minutes, but it's done a lot of late. You're bearish on the dollar even from here, even after it's pulled back?
Well, whether this is our Liz Truss moment, Wilf, or whether this is, the Trump administration organizing their own Plaza Accord, for those looking at history books, that's 85, when the U.S. essentially re-engineered a new valuation against the dollar with the foreign trading partners. But I think traders look at ranges here on the Dixie and also look at where dollar euro can go. I think euro can probably go to to 120, excuse me. And it's just fascinating because if you look at what dollar euro cross was mostly trading on in the last 2 to 3 years, maybe 5 years, it was central bank differentials. Now it's obviously regime change. And so I think technically we've had a big move. It's almost a 10% move from late January to the intraday lows on Friday, and zigzagging a bit today. But obviously the assessing of whether the U.S. is not only looking to change, restructuring the economy in a way that the rest of the world is not comfortable with, but obviously this comes after years of that U.S. exceptionalism that I think it probably was long in the tooth. We could have been talking here a year ago saying that I think at some point we'd run long in that trade. I
was reading your notes, Tim, and I like it. Make international great again. As a Brit, I support this call. But really, is the innovation going to be there? Is it just an attractive thing to do if the dollar's weakening, or a temporary trade, or do you think it's a long-term moment to buy international stocks?
Well, I like the call, too. And I've been investing globally most of my career. I ran long, short EM money. I've been running global for a while. I run an international ETF, IDEVO today. And so the relative capital flows are a powerful dynamic here. But then you just get into dynamics with the currency. And as you're probably aware, investing internationally, the currency is anywhere from 20 to 50% of your return profile. And if you think the dollar is going to continue to weaken, that's a strong argument. But valuations internationally are attractive. And that wasn't always enough to do it in the past. But this has been one of the triggers. And if you look at European banks, we're long Barclays, we're long Santander. These are world-class global banks, balance sheets that are fantastic, just as good as the U.S. money center banks, higher free cash flow yields, and paying higher dividends. So at a time when the GDP differentials between the U.S. and Europe are such that we really haven't been here in a while. And I think that's very attractive.